What's up, Colorado? A very common question we're getting right now is what will happen to cap rates as interest rates have jumped up dramatically this year? So in this podcast, I got Lon Welsh, the founder of Your Castle and Ironton Capital, here to go over all sorts of economic data, some historical stock market data for points of reference, but also a bunch of history on how cap rates change or don't change during times of interest rate change. Lon, glad to have you back in the studio.
It is great to be here.
And this is such a timely topic and one I've gotten asked numerous times. I've asked myself, and I know when things pop up, you go in and do research and do models. And that's exactly what you've done today on this couple slide deck presentation. So run us through the history of the stock market and what happens in environments like this.
I'm delighted to share all this with you because I didn't really know very much about this myself until I started digging into the figures. So this first chart that I want to show you shows you the 14 bear markets that we've had with the stock market since the Great Depression back in 1929. And you can take a look at the chart and you'll see what type of crash was it, when did it occur, when was the start, when did it finish, and then drawdown. That means how much did the stock market correct? So for example, during the Great Depression, it was an 86% decline. How long did it take? And then how long did it take to recover? So the main thing I want to look at today is a lot of our investors are thinking, all right, I've got $100,000 sitting in my checking account. The Dow is off about 24% from its high. So if you're not familiar, a bear market is when the stock market declines by 20% or more. So we're at 24% decline. Should I take that $100,000, put it in the stock market because this might be a buying opportunity, or should I put it in the real estate market instead? Because I'm worried about the real estate market. You know, rates are going up, so cap rates are going to go up, so there's not going to be any appreciation. So we're going to see if that's true or not today. So the first thing I want to point out to you is that of the last 14 times that we've had a stock market bear market, you can see where I circled in red that after the 20% drop, 6 times the market continued to drop afterwards. So just because it's dropped 20% isn't a really reliable buying indicator. It's almost a 50-50 chance about will it go down more, or are we in fact actually at the bottom? So that's the first thing to know. If you look at all the way on the right-hand side, you see where it says recession, there's an X. Usually these bear markets took place in a recession, but not all of them. So if you eliminate the 3 of them there where we had a stock market that declined by 20%, that we're not in a recession, it's actually slightly worse than 50%. There's actually slightly more of a chance that the stock market's going to go down because we're going to go into a recession. I'm pretty convinced of that, and I think most Americans are, then the stock market's going to go up. So that's one reason why I wouldn't be too excited about putting money in the stock market right now. It may be just a little bit too soon.
And before we jump on the next slide here, I forgot to make a note at the beginning. This is a very slide-intensive presentation.
Yep.
Lon's doing a great job of going through numbers. If you want to reference it, make sure you check out the YouTube video or check out the blog post. We'll have these charts and graphs up there as well. And of course, you can always email me and Lon.
Yeah, we're very happy to share all this. I mean, the more educated you are as an investor, whether you pick us or not, the better investments you're going to make. And that's my real objective here with all this. So I want to talk a little bit about the 10-year Treasury. So the U.S. government has to borrow money in a number of different ways, but the most popular way by far is the 10-year Treasury. It's the most liquid debt security instrument on the planet by far. And this shows you a chart over the last several years of what the 10-year interest rate was. So you can see currently we're tracking a little bit below 3%. What I want to look at here is that if you take a look in 2020, where I've got that little yellow circle, right before COVID, you can see the interest rate was 2%. We had this huge decline of 1.5 points as we tried to stimulate the economy while we went through this COVID panic. And then we saw the interest rates come back up as that stimulus wasn't needed to get the economy jump-started. So when you talk about the fact that interest rates in forms of the 10-year, for example, are up by like 2.5% in such a short period of time, it's very important to realize that 1.5% of that 2% is just recovering from COVID. So in reality, we have a 1% increase in rates. We don't have a 2.5% increase in rates. So that's probably the first mental framing sort of a thing. The next thing I want to bring out on this chart is that if you look between like around July of 2018, you can see that the rate was about 3%, just exactly as it is right now. So a year or so before COVID started, the rate environment is exactly where we are today. So I don't want people to have the idea that we had these super duper low rates for 30 years and all of a sudden out of nowhere it went up by 2.5% overnight. Like that would actually be a much more serious situation. this rate environment's not as scary as the media's made it out to be.
Yeah, I mean, people got whiplash from being these crazy ultra low interest rates that the government pushed down 2 years ago, and so just made it such a dramatic shock.
Yeah.
Of like, oh, it went up. It's because we were at the so low.
Yeah, so it's all just about the relative thing. It's like when you're driving on the interstate at 85 miles an hour and you pull off on an off ramp and now you're driving 45. It feels like you're just crawling. You're still going 45 miles an hour. Okay, this chart is probably the one you're going to find most valuable, and I'm going to spend a lot of time interpreting this so you can really extract all the wisdom this chart actually has in it. So this is 40 years of data, and the dashed blue line is the 10-year Treasury rate. We were just looking at that a second ago, like on a 5-year view. Now we're looking on a 40-year view to get all of the history that we have available. And then that orange line is the cap rate. So for the earlier years, it's a blend of all commercial asset classes because that's the only data that I could find. In the most recent 20 years, it's multifamily because that's what I'm most interested in talking about today.
Mm-hmm.
So I got the data to be as consistent as I was able to find. So, the main thing here to take a look at is that the trend overall for 40 years is that interest rates are going down structurally, and the cap rates generally have gone down as well. So there's not a whole lot of correlation between the two of these, but I want to really dive into the details for a second. So this takes a look at, there's been 9 times where the interest rate as measured by the 10-year Treasury has very quickly spiked up by at least 1% in a short period of time. And I want to take a look at what was the impact on the cap rate the other 9 times that this occurred, just like what we're experiencing right now. And you can take a look and you can see, like, let's look at 1981, for example. The interest rate went up by 1.9%. The cap rates dropped by 0.3%. Wow, that's unusual. All right, how about in 82? Rates went up another 1.8%. Cap rates dropped again. And you could take a second to look at all of these, but in the last 40 years, in the 9 times when the interest rate spiked, the average change in the cap rate was a 0.1% decline in the cap rate.
0.1% or 0.1%?
0.1%.
So we're talking a tenth of a cap rate point, which is a negligible.
Yeah, it's a rounding error.
Yeah.
It's like almost not, it's not even statistically significant, really.
Yeah, when I saw this chart, I think last week or 2 weeks when emailed out, this just, I loved it, but it surprised me. I thought there would be.
Surprises everybody.
I thought there'd be a bigger correlation.
Yeah.
Because borrowing costs go up, that's going to impact cap rates, right? I guess not.
Exactly. So far in 2022, we've seen that the 10-year Treasury is up by 2.1% and cap rates are unchanged. All right, so what's the catch? Let's take a look at the other slide. So this shows you all the times when the 10-year Treasury has quickly dropped by 1% or more. And there's 9 instances of that. And guess what? The cap rate on average changed by 0.1%. So the thing is that whether the interest rate goes up by 1% or if the interest rate goes down by 1%, the cap rates just don't really change all that much because they're not correlated. They're entirely different markets. So let's take a look at this here. If you take a look at 2022, the rate's up by 2% for interest, cap rates are unchanged. Well, what about 2021? We saw that rates dropped very quickly by 1% to stimulate the economy because of COVID. Did we get any benefit when the rates dropped? No, cap rates stayed the same. So really what's happened here is we've done a complete round trip. We've had the interest rates go down, then we had the interest rates go back up, and the cap rate stayed the same throughout the entire period.
Yeah. The other thing that popped my mind as we've been talking about this, some of these charts, is looking at a lot of other countries, like the European countries, some Asian countries, where their cap rates are, 1 or 2%.
Right.
And that's, they literally have no more land to build on the island or their 1,000-year-old, Citadel. Yeah. Like there's just no land to build.
Right.
There's no supply, and their cap rates, no matter what the economy does or what interest rates do, is low and low and steady. And that's the reference point. I'm like, well, yeah, cap rates can always go lower in America. They did over there and there. Why wouldn't that happen over here eventually? Potentially. Like that's been in the back of my mind as well.
They could keep drifting down.
Yeah.
So I tell you, if you just take a look at this slide here on the right bottom part of the chart where you see the rates went up by 2%. If you just bring your eye back a little bit, you can see back in 2019, the rates in 2019 were exactly where they are right now at about 3% for the 10-year Treasury. And you can see that the cap rate is maybe a tenth higher, maybe 2/10 higher than it is right now. So just not a lot of a change there. So I'm just going to flip between these 2 charts really quick. And what you see is that pretty much every time the rate spikes by 1%, almost always the rate drops the next year. So that's a really normal pattern. What you usually see is like right before a recession, you'll see a run up in the interest rates as the Fed tries to control what's going on in the economy. It tips us into a recession. And every time you have a recession, you'll see the rates drop. We have a different podcast where we're going to discuss that. But all this is just normal behavior. So there's no reason for panic that cap rates are going to change all that much.
Yeah. And I think that's one of the things to keep in mind. I mean, obviously, like we don't have a crystal ball, but looking at history, one of the strategies that I've looked at and a lot of investors are doing as well, if they're looking at, buying properties directly, some people are putting arms on there, anticipating that in a year or 2 years in that time frame, exactly what happened. Recession will happen, Feds will lower the interest rates, and then they can refinance into a lower debt product or a lower, longer term debt product.
I think it's a really sophisticated strategy every buyer should be looking at right now, is trying to look at forms of debt that don't have much or no prepayment penalty at all, ideally. So they've got the option to take advantage of what you just described. So this is just a 20-year return chart by income of different asset classes. So you can see over the last 20 years that household income hasn't done a whole lot. The S&P 500 is up like 150, 180%. 180% gain in 20 years is pretty respectable. Nothing wrong with that. Home equity without leverage is up less than the stock market, but for a typical person putting 20% down, it's like in the 700% range. So real estate blows the doors off the stock market. Just one more piece of evidence for that.
Yeah, and it kind of goes back to what we talk about all the time is that, real estate's a great investment compared to the stock market, but it's the leverage aspect of real estate that really makes it gangbusters.
Right.
Because, you don't get margin like you do on the stock market like you do on homes when you buy them.
Yep.
So yeah, leverage is key when it comes to real estate, whether you're buying directly or investing passively. All the indicators point to using leverage to maximize returns.
Exactly. So I appreciate your guys going through this. A lot of really detailed charts today, but I think there's some really important lessons we can draw from history and learn from.
Yeah, I found this fascinating, Lon. And as a reminder for everyone, the charts and graphs in the YouTube video and also in the blog post. So go check it out. If you have any questions on this data or investing with Iron Capital or buying rental properties, reach out to us. This is the stuff we eat, sleep, and breathe, and we love talking about it. We'll see you next week.
Thank you so much, guys.